In this chapter, we'll move from theory into practical action. If you've been following along, you now understand what the stock market is, why it matters, and some key principles of investing. Now it's time to roll up your sleeves and start your journey with a clear, simple, and actionable plan. Before you invest a single dollar, you must know why you're investing. Are you saving for retirement? Do you want to buy a house in the next 10 years? Do you simply want to grow your wealth passively? Imagine Sarah, a 28-year-old nurse in Indiana. She starts investing $200 a month with the goal of buying her first home in 10 years. By defining her why, she knows she should choose safe for medium-term investments rather than risky penny stocks. If you don't know your goal, the market will decide it for you. And trust me, that's a gamble you don't want to take. This is where many beginners go wrong. Investing is important, but you should never put your last dollar into the market. Save at least 3 to 6 months worth of expenses in a savings account. This is your safety net in case of job loss, medical emergencies, or unexpected bills. Pushpin relatable example. John, a delivery driver, invested all his money in stocks without an emergency fund. When his car broke down, he had to sell his investments at a loss to cover repairs. If he had an emergency fund, his investments could have kept growing. Think of your emergency fund as a parachute you pack before jumping into the world of investing. You can't invest without a brokerage account, which is like your gateway to the stock market. In the U.S., popular beginner-friendly platforms are Robinhood, Fidelity, Charles Schwab, Vanguard, and E-Trade. Many of these apps are free to use and allow you to buy fractional shares. Great if you don't have thousands to start. Think of Alex, a college student who started with Robinhood. He only had $50, but he was able to buy a fraction of Apple stock and learn how the market works. Fast forward 5 years, his small habit of investing grew into thousands of dollars. Light bulb hook for viewers. Opening a brokerage account today is easier than opening a bank account. It takes less than 15 minutes. Here's the fun part. Picking your investments. As a beginner, don't overcomplicate things. Index funds and ETFs. These track the entire market, e.g. S&P 500, and are safer long-term bets. Blue chip stocks. Companies like Apple, Microsoft, or Coca-Cola that have a history of stability. Avoid risky penny stocks or hot tips until you're experienced. Pushpin example. Emily, a beginner, chose to invest in an S&P 500 ETF. She wasn't chasing the hottest new stock, but instead bet on the U.S. economy as a whole. Over time, her investments steadily grew. Light bulb hook for viewers. Remember, beginners don't need to pick the next Amazon. You just need to bet on the entire economy and stay consistent. One of the best hacks for beginners is automation. Set up automatic transfers from your bank to your brokerage. This way, investing becomes as natural as paying your bills. Pushpin relatable story. Mike, a teacher, set up a $150 automatic monthly investment into a Vanguard index fund. He didn't even notice the money leaving his account. 5 years later, he had over $12,000 invested without ever feeling the effort. Light bulb hook for viewers. Make your money work for you while you sleep. Automation is the secret weapon of long-term investors. The hardest part of investing is not touching your money when the market goes up and down. The market will rise and fall. That's normal. Stick to your plan. Keep investing and don't panic sell. Pushpin example. During the 2020 pandemic crash, many investors sold out of fear, but those who held on saw the market bounce back and even reach new highs. Patience paid off. Light bulb hook for viewers. The stock market is a money transfer machine from the impatient to the patient. Which side do you want to be on? With these steps, anyone watching can literally start investing today. Starting your investing journey is exciting, but it's also a place where many beginners stumble. In this chapter, I'll walk you through the top mistakes new investors make and exactly how you can avoid them. Think of this as your investment survival guide. Too many beginners jump in because they saw a TikTok, a news headline, or a friend bragging about the next hot stock. If you don't have a plan, you're just gambling. Without clear goals, it's easy to buy and sell emotionally. Pushpin example. Mark bought Dogecoin in 2021 because everyone online was hyping it. He had no plan, no exit strategy. When the hype died, he lost half his savings. How to avoid it? Always ask, why am I investing in this? Write down your financial goals before buying any stock or fund. Light bulb hook for viewers. If you don't set the rules, the market will set them for you, and you probably won't like them. How to avoid it? Always ask, why am I investing in this? Write down your financial goals before buying any stock or fund. Light bulb hook for viewers. If you don't set the rules, the market will set them for you, and you probably won't like them. Beginners often get caught up in hype. Social media, friends, or even news channels can create fear of missing out FOMO. By the time you hear about a hot stock, it's often already too late. Pushpin example. During the GameStop frenzy, thousands of beginners jumped in at the peak, only to watch the stock tumble days later. White have checkmark how to avoid it. Stick to proven strategies like index funds, ETFs, and long-term investing. Avoid impulsive buys based on hype. Light bulb hook for viewers. By the time it's trending, the real money has already been made. Beginners often get caught up in hype. Social media, friends, or even news channels can create fear of missing out on FOMO. By the time you hear about a hot stock, it's often already too late. Pushpin example. During the GameStop frenzy, thousands of beginners jumped at the peak, only to watch the stock tumble days later. White have checkmark how to avoid it. Stick to proven strategies like index funds, ETFs, and long-term investing. Avoid impulsive buys based on hype. Light bulb hook for viewers. By the time it's trending, the real money has already been made. Putting all your money in one stock is like putting all your eggs in one basket. If that one company fails, your money goes with it. Even safe, companies can struggle unexpectedly. Pushpin example. Blockbuster was once a giant, but investors who bet everything on it lost big when Netflix disrupted the market. White have checkmark how to avoid it. Spread your investments across different industries and asset types. Index funds and ETFs are built-in diversification tools. Light bulb hook for viewers. Don't marry one stock. Date the whole market instead. Beginners often obsessively check their portfolio every hour. This creates stress and emotional decisions. The market naturally goes up and down. Daily swings don't matter in the long run. Pushpin example. Anna checked her portfolio 10 times a day. Whenever it dipped, she panicked and sold. She ended up losing more than if she had just stayed calm. White have checkmark how to avoid it. Check your portfolio monthly or quarterly, not daily. Remember, investing is a marathon, not a sprint. Light bulb hook for viewers. If you wouldn't panic about the price of your house dropping today, don't panic about your stocks either. Beginners often obsessively check their portfolio every hour. This creates stress and emotional decisions. The market naturally goes up and down. Daily swings don't matter in the long run. Pushpin example. Anna checked her portfolio 10 times a day. Whenever it dipped, she panicked and sold. She ended up losing more than if she had just stayed calm. White have checkmark how to avoid it. Check your portfolio monthly or quarterly, not daily. Remember, investing is a marathon, not a sprint. Light bulb hook for viewers. If you wouldn't panic about the price of your house dropping today, don't panic about your stocks either. By now, you know why investing is important, how to get started, and which mistakes to avoid. Now it's time to actually build your first portfolio, your personal collection of investments. Every portfolio starts with one big question. Back-end index pointing right. How much risk am I comfortable with? Low risk. You hate losing money. Even short-term focus more on bonds and broad index funds. Medium risk. You can handle some ups and downs, mix of stocks and bonds. High risk. You want long-term growth. Okay with volatility, focus heavily on stocks and ETFs. Pushpin rule of thumb. The younger you are, the more risk stocks you can usually take on, since you have time to recover from dips. Your portfolio should have a core foundation, the reliable part that grows steadily over time. Index funds and ETFs recommended for beginners. Example, S&P 500 ETF, like SPY, VO, or IBV. Example, total market ETF, like VTI. Bonds or bond ETF for stability, like BNB. White have checkmark Y. They're low-cost, diversified, and proven long-term performers. A light bulb hook for viewers. Instead of betting on one company, buy a slice of 500 companies at once. Once your core is set, you can add small satellite investments, 10 to 20% of the portfolio. It could be individual stocks you believe in. It could be sectors tech, healthcare, renewable energy. It could be REITs, real estate funds, for extra diversification. Warning important. Don't let satellites outweigh your core. Your foundation should always be strong. Your portfolio is like a recipe. You need the right mix. Example allocation for beginners. Conservative, low risk. 60% bonds, 40% stocks. Balanced, medium risk. 60% stocks, 40% bonds. Aggressive, high risk. 80 to 90% stocks. 10 to 20% bonds. Pushpin example. A 25-year-old beginner might do 80% stocks via ETFs and 20% bonds. Instead of waiting for the perfect time to buy, invest a fixed amount consistently, weekly or monthly. Example, $200 into an S&P 500 ETF every month. This removes emotion and takes advantage of long-term growth. Light bulb hook for viewers. Don't wait for the right time. Make the time right by investing consistently. Over time, some investments will grow faster than others. This shifts your mix. Pushpin example. If you plan for 80% stocks and 20% bonds, but stocks grew to 90%, you should sell some stocks or buy more bonds to rebalance. White heavy check mark check. Rebalance once or twice a year. Beginners often overcomplicate their portfolios with too many stocks and funds. You don't need 20 different ETFs. A simple mix like one total market ETF, VTI, one bond ETF, BND. Optional, one or two satellites is more than enough. Light bulb hook for viewers. Simplicity wins. Your portfolio doesn't have to be fancy to make you wealthy. With this setup, you'll have a strong foundation for long-term success without getting lost in the noise.